Verizon Communications Inc., ticker symbol VZ, is down 5% today to $41.50 a share. This is because they just released their Q3 earnings for 2024 and the market hasn't really liked what they have seen. So what we're going to be doing is doing a quick breakdown of this, then taking it to my automated stock valuation spreadsheet, seeing if Verizon is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So let's quickly jump into the numbers here. We have 3 months ended, 23 versus 24, and also the 9 months as well. Revenue is down slightly, 33.336 down to 33.330. 9 months is up actually slightly of about 300 million, 98.8 compared to 99.1. Net income, the profit is down 4.8 billion to 3.4, and you can see in the 9 months as well, 14.6 to 12.8. So revenue down very, very slightly, profit down quite a bit. You can see the operating income is down 20%. Everything else is pretty much up, and obviously then the net income is down as well. So next we look at the free cash flow. As a lot of things that people are interested in is the free cash flow, and I have scrolled past it. It is up here. Free cash flow is cash from operating activities minus capital expenditures, which is down here. They don't have free cash flow as their own dedicated line, but we can see here on the 9 months, and we can work out the quarter as well by comparing what we have in Yahoo Finance. But 14.6 down to 12.8. That is the net income, and then the net income from operating activity, net income provided by operating, net cash provided by operating activities, 28.8 down to 26.4, and the capex is actually down slightly, 14.1 to 12 billion. So if we look at the free cash flow for the trailing 9 months is around about 14.5 billion, if my maths is roughly right. Now, if we go to Yahoo Finance, the free cash flow in the 2 prior quarters is 15.6 and 2.2. Obviously, minusing the 14 as well. Well, minusing those from the 14 gives us around about 6.5 billion in free cash flow. So it doesn't look too shabby. So what we'll do is we'll look at my automated sheet, and we will put in some of the numbers. So if we put in ticker VZ, this will load up all the latest company financials, but there is a bit of delay on these. Even Yahoo Finance doesn't have it, as we saw. So what I can do is I can override the numbers here, and we can put them over here. So we said that the net revenue was, I won't flick between the sheets on here, I'll just keep it open, and so that way I have it on another sheet here. So 33.30, that's 33 billion. You can see, hopefully this number should change now. Actually pretty much the same, which is quite interesting. Net income is the, well, we know that actually because the prior quarter went down very so slightly. Net income, we currently have around about 3.4 billion. So you can see now that number has updated, and this is updated as well. Shares outstanding we don't look at. So cash operating activities, free cash flow. We're just going to override the free cash flow here directly because I've already done the maths. I don't want to do it again, all the math. 6.6 billion. So you can see actually free cash flow is up to 14.6. So just quickly, market cap 175 billion, PE of 15, quite low, earnings per share $2.67, a beta of 0.42. Analysts are saying is a buy with $46 a share. Dividend yield 6.2, meaning you'll get paid $2.57 a share. It is not a very safe dividend. In terms of net income, way over 10.8 billion compared to 9. Payout ratio, free cash flow, pretty high as well. If we look at the 22 numbers, 21 and even 20, these was a lot safer. 2023, not so much negative free cash flow, and obviously 14.6 billion here. But if you want to buy the shares, buy before the 10th of Jan to get paid the quarter of the dividend. So let's have a look at the revenues here. Revenues, as we said, pretty consistent, but up ever so slightly in the trailing 12 months. Net income down 9.9 billion. Free cash flow growing in the right direction. That is what we want to see after obviously bad 2020-21. This is operating income versus capex. Capex massively up in 2021 and then has dropped down to its normal levels and actually decreasing, whereas operating cash flow has, it's down a little bit. Shares outstanding, you can see that they are issuing more shares slowly over time, which means they are diluting shareholders. Let's have a look at the discounted free cash flow model. This is a way of calculating the value of a company, looking at the future free cash flows and discounting them to today's value. If we look at averages, it puts it at a calculated stock price of around $60 a share, meaning this is a buy. We are estimating 135 and 136 billion in the coming years. Let's see what analysts are expecting. 34, 37. So yeah, we're probably in rough lines there. Net income margins, they have been decreasing actually, so I'm going to drop this down a little bit to 10%. And then free cash flow, all over the place here. I mean, consistently, you know, if we put it to 100, it's probably going to jump up to, yeah, $134 a share. I think that is a bit bullish. But if we sort of take averages of 21, 22, that will put it at about 88%. Still $134 a share. So discounted free cash flow model really, really does like this stock. We'll quickly go on the dividend discount model. What this does is it looks at the the growth of the dividends over time. And you can see actually it is decreasing. So I'm going to bring that down to around about 1.9. And the current weighted average cost of capital is around 5%. So if I was to take an average of that, it would put it at around about $87 a share, but normally the discount rate we put is a bit higher, 8%. That actually brings it to an intrinsic value of $44, meaning there's a slight buy, interestingly enough, but they need to keep on increasing the dividend. You can see the dividend has increased over time, but I would like those dividend growths to be increased as well. Finally, well, not finally, second to last, Ben Graham formula for intrinsic value. We'll quickly go through this. This is the formula created by Ben Graham that looks at the earnings per share. And analysts are thinking very low growth, 0.7%. So we'll just put in 1% because I don't think you'll like it. No, $23 a share with a 1% growth. Looks at earnings per share, P of non-growth company, AAA bond yield, things like that. So for Verizon to be a buy, you can see it would have to be growing at around about probably 10% a year for it to be fairly valued. And obviously, you want a good return on that, somewhere in the region of 12 to 15. So Ben Graham would not like Verizon in its current state.